from Sempar. Following on from yesterday's autumn budget, we recorded a short review with Pete, our head of tax, who is joined by Alex Morton from Q Financial Planning, to share their thoughts on yesterday's announcements. Thank you, and we hope you enjoy.
Thank you very much, Em. So we've had the budget today, and it is now 3 o'clock after the budget, and me and Alex thought we would just have a bit of a chat about what happened and any thoughts that we've had. So, Alex, what's your kind of takeaway from the budget?
I think overall it's fairly positive. I mean, there's still a few question marks about a few areas that were tactfully glossed over, let's say, but you know, there's a few positives to take away from it. Economic uptick is great, and the growth is better than expected. The government borrowing is down, lower than expected, so that's shown that the recovery is ahead of where they expected it to be. Jobs are up. I know there's a bit of a lag between vacancies and applicants at the moment, so although the numbers are down, there's plenty of opportunity for those to get into work, so that's a great thing as well. I think the only real major concern is the inflation side of things. You know, it was 3.1 in September, and the CPI average is expected to be up to about 4% over the next year. So for me, that's one area where I think a bit of action can be taken to try and offset that and soften the burden a little bit. But overall, I think fairly positive, and there's certainly still some good planning opportunities to be done, even though there's not been any significant changes. It just means that we've got a bit more time to be able to take advantage of those. How about you? What was your perspective on things?
Yeah, I think obviously in March we had the increase of corporation tax rate coming in, and in September they announced the extra national insurance to fund the NHS. There were the big tax things from this, and there wasn't too much more in terms of tax increases in this budget. It was quite light on tax for a budget for many of the year. But that does mean that we've got still got opportunities, and there is the increase of annual investment allowance that's staying the same with 1 million, and that's continuing on till March 2023, along with a super deduction that was announced last year as well. So with those two things in mind, I do think we do have quite a few opportunities still. One thing I think both of us really picked up on in terms of what wasn't said was to do with the pensions, and there was quite a lot of talk about whether the pension relief would be removed or anything to kind of combat that. Nothing was said there, was it? So
no, it's an area that's been sort of highlighted as something that might be addressed for a period of time. You know, with the pension tax simplification, I know that was something that there was consideration about, but reassuring in the fact that there's not been any changes. It is quite a big burden for HMRC every year for the tax relief that's obtained on contributions. So, equally, it's positive for those that do have a pension that there's still plenty of capacity to continue doing so. And another thing that wasn't mentioned, which I'm sure you're probably going to move on to, was both CGT and IHT, and the thresholds and the rates involved in those. So again, it can be seen as an opportunity. I think there was a lot of market commentary, especially in the financial services sector, that there were likely to be some changes around CGT and IHT. So the fact that they've potentially delayed that for a little bit longer still gives scope and reasons to do planning in and around your allowances each year, definitely. And I think although there is going to be the scheduled increase in corporation tax, in one way it should then incentivise businesses to do more for their staff and do more for their employees by making use of available allowances or allowable deductions. So that could be to increase the staff benefits package, or to actually begin offering a staff benefits package to retain those key staff. That can include things like group life cover, group income protection, group critical illness, group private medical, and all of these are an allowable deduction against corporation tax. So with the rise going up from 19 to 25% for some, there's an even greater incentive to help reduce overall tax positions by including things like these benefits. And that can also include increasing pension contributions, employer pension contributions I should say, because again that's another allowable expense against your corporation tax bill. So if the wage increases aren't going to be there, incentivise employees in another way, and there's a lot of research that shows that increases in benefits package compared to competitors is seen in a much more positive way for employees. So although the wages might not be at the level they might desire or increasing quickly enough, by including these other benefits in, it helps softens the blow and helps cement the reason as to why they're choosing that employer, for example.
Yeah, and I suppose that kind of goes along with the increase of the national insurance for NH to fund the NHS, that actually something like a pension contribution, increasing that might not get actually affected by that increase, whereas if you had it in salary it would. So those benefits there, they might have that better impact and therefore more money in your overall, not your take-home pay, but your overall wealth post-work as well as now. So that's probably quite a big thing, especially for directors at the moment. We see it quite a lot with directors looking to reduce corporation tax, and putting through pension contributions is always a really good way of being able to do that. So you mentioned a little while ago about the capital gains tax. Nothing's changed there, and the allowances are still there. There was a lot of talk about that going up to be the same as income tax, whereas that hasn't happened. So I still think there's probably quite a lot of planning that can be done around that, and I bet you'll see that quite a lot within the financial planning industry.
Yeah, definitely. I mean, even if it's just a case of whether people are making use of their annual allowances, they might have assets or investments that they've not capitalised on using their allowances each year. They're continuing to grow, so that capital gain is increasing. And if you're not chipping away at those gains each year and making use of your allowances, eventually there'll be a much larger tax hit, unless you've got significant losses to offset against that. So it's encouraging because it's giving the opportunity for advice, and it's giving people the opportunity to take some planning steps now so that they're retaining more of their wealth, they're not paying more tax than they absolutely need to. It could be a tax efficiency exercise, going from a general investment account into an ISA, or bed and ISA-ing as it's known, and that's one really simple step that people can do that doesn't take an awful lot of effort. It's quite a short process, but what it just means is that there's a lot more of the profits that are being retained and they're not then liable to tax. In regards to planning with CGT, it's an opportunity for those that maybe have property that they were looking at considering at offloading, while they're not reducing the allowances or increasing the tax rates. That could be a planning opportunity to make use of moderate gains. Obviously the more significant gains will still be taxed at the additional rates for secondary properties. But again, it's just another conversation piece. Even if there's no planning done, people are aware of what their liability is going to be as and when that time comes. So it's just having a healthy conversation about these planning opportunities, and people are informed then, rather than having that, oh wow, I've got this CGT liability, I wasn't expecting it to be that. What can I do to mitigate against that? At that point there's very few options, but the earlier the planning can be started, the greater the benefit is going to be to the client.
And that's the same for the inheritance tax as well. We find that quite often the capital gains tax, because it's a lesser rate than inheritance tax, that people pass on assets in their lifetime. They might incur a little bit of capital gains tax, but they can save inheritance tax in the future. So having those rates at a different way is allowing that succession for inheritance tax, and the inheritance tax bands have all stayed the same, and the inheritance tax rates have stayed the same. So it tends to be a couple with over £1 million worth of assets are likely to have some form of IHT bill. So there's still, and as people's assets are increasing, that people are coming more into inheritance tax now, because the £325,000 nil rate bands haven't increased for several years. So I think there's a lot of planning to be done there, and a lot of people probably need to just have a chat about those sorts of things, because again, like Alex said in capital gains tax, first of all you need to know where you stand, and then you can see whether you need to do anything around that. So I think that's probably something that could change in the future, but hasn't at the moment.
Yeah, I think it's one of those sort of low-hanging fruit taxes that is easy to make a change on, and for the vast majority of the population it probably won't affect them, but for those who it will affect or is likely to affect based on growing estate wealth, then having that conversation now about planning opportunities and having that awareness of how to do it in a way that's not going to be viewed retrospectively as a disposal of assets, or it's not going to be causing liabilities to more immediate tax problems if large gifts are made, then it just gives them an informed position to be in again. And while the rates and allowances haven't changed, now is the time to start doing some planning if it was something that is being considered or is likely to be an issue in the next few years, because by the time the rates change again, you're already going to be on the back foot. You've got a limited timescale to then be able to implement the changes, whereas if you implement the changes earlier, then it's going to make life an awful lot easier in the future.
So other things that kind of came out in the budget, one thing that will be a benefit to a lot of people is there's rates relief for some sectors such as the hospitality, retail, leisure and entertainment industries for the next 12 months. And there's also rates relief for people who are investing in green investments like solar panels. Therefore, you can have rates relief and by investing in those assets. Other things to mention, there was the minimum wage increase from £8.91 to £9.50, and also there is reduction in the taper relief for universal credit, so that's gone down from 63% down to 55%, so that will be more money in the pockets of the lower income households, which I'm sure will be a benefit to a lot of people. And then finally, there is a few tax benefits for pubs and hospitality in terms of the levies that are on alcohol drinks have now been lined up to the percentage alcohol that's in them. So that's a big one for people who drink sparkling wine, and so that there's no 28% premium on that anymore. Do you think this will be getting you back into the pub, Alex?
I don't need any encouragement. But yeah, I think it's great, and I think the hospitality sector, as we all know, has probably been hardest hit than many other industries, just because it's been completely curtailed. So, you know, any form of assistance to help that sector. I mean, the British population is founded on pub and social culture, isn't it? So anything that can be done to help improve that, because we all know how many are allegedly closing each week up and down the country, so any stemming of that's only going to help. 3 pence in the pint, it would be nice to have been seen a bit more, but you know, got to start somewhere. Yeah, and it's good to see that, and especially with the reduction in the rate relief for those industries as well. That's certainly going to help soften the blow and help the recovery, I think, going forwards.
Brilliant. And have you got anything else that you took away from the budget today?
No, the only real thing is that if you've got significant cash holdings, they are going to be languishing behind inflation. So that's another great conversation topic for planning opportunities. That at the moment, if you're lucky with a 5-year fixed term, you might be getting just around 1%, 1.5%, maybe slightly higher than that at absolute best. So worst case scenario, you're still going to be languishing 2-3% behind inflation. So it just devalues what you're able to buy in the future based on current levels. So making the cash work harder for you is definitely a conversation that I would encourage people with significant cash holdings to have, because otherwise you're going to be left behind when you actually come to want to use it in the future and the cost of goods have gone up.
Brilliant. Well, I'd like to thank Alex for coming along to Sempar today to watch the budget with us and provide his thoughts on it all. So thank you very much, Alex.
All right, my pleasure.